Hi, everyone. This is Jason Bierk of Wall Street from Main Street. Welcome back for another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. I've known him for many years. Actually, I think he learned Austrian School Economics from watching my YouTube videos over a decade ago. He's a very successful entrepreneur. He's built up businesses from the ground up and sold them. Also a very successful real estate investor. I think he was buying when there was blood in the streets. Back when real estate prices crashed, home prices crashed before the Fed started the QE program. He was buying rental properties. Most of my listeners know him from Rebel Capitalist and building up his YouTube channel the last 4 or 5 years is now one of the largest financial YouTube channels. George Gammon, thank you for joining me again.
Hey, thanks for having me back, and thanks for doing the podcast. You're absolutely right. When I first started to learn about macro, your podcast was definitely one of my favorites.
I was one of the earliest ones. Yeah, there wasn't many of us back then. I mean, now it's like it's big business with YouTube. It's really tough to grow subscribers now in financial YouTube.
Yeah. Yeah. So, dude, lots to talk about, man. There's a little bit of volatility.
Oh, the bloodbath, you mean? You've been putting out Rebel Capitalist videos the last couple of weeks, actually for months now, warning about smart money. So like institutional investors, hedge fund managers, Warren Buffett, others that were buying long-term U.S. Treasury yields. Why do you think there's been a huge decrease now in the bond yield for U.S. Treasury yields and the 10-year U.S. Treasury yields down to 3.96% when we're recording this interview on Wednesday, August 7th, 2024?
Well, you've seen a huge drop in yields starting about, I don't have the chart in front of me, but maybe a couple months ago. And it got all the way down on Friday to where we had an uninversion of the 2s and 10s. And if my memory, it only lasted about 5 minutes. I took a screenshot of it and put it up on Twitter. But if my memory serves me right, the 10-year got down to 3.69, and the 2-year, remarkably, got down to 3.68. So a lot of people, and now since then, yields have gone back up, but they have just gone back up a bit, just as you would expect. You don't expect them to go straight down. So the reason that's so extraordinary is the decline in yields for the 2-year. So the front end of the curve, in other words, coming down much, much faster than the long end of the curve, which would tell you that it is steepening out. We are seeing an uninversion, but importantly, we're seeing an uninversion due to the bull steepener, which is the opposite outcome as a bear steepener and leads you to completely different conclusions about the health of the underlying economy. When you have a bull steepener, which is basically the front end going down faster than the long end, it tells you that in the Treasury market, they're expecting lower growth and inflation, and they are expecting the Fed to cut rates, and they're expecting the this reinflation cycle to not really play out, and they're expecting a recession or a slowdown in the economy, I guess is the best way to say it. And a lot of people think that the Treasury market is predicting exactly where interest rates will go. That's not really true. It's just predicting kind of the trend for growth and inflation. So if we were to see the economy booming, if we were to see the economy running on all 8 cylinders or no chance of a recession whatsoever, then you would not see an inversion. What you would see is an uninversion due to the opposite, which is a bear steepener, and that's the long end of the curve going up faster than the front end of the curve. And if you just sit back and think about it, it makes a lot of sense. The fact that short-term interest rates are higher than long-term interest rates is highly abnormal. I mean, who would do that? Just who would lend to someone for 30 years at a cheaper interest rate than they would lend to someone for 1 month? It makes no sense just at face value. So then you have to say, okay, well, what is this telling us? Well, it's telling us something's wrong. We know that definitively. So then we have to say, okay, well, how does this play out? And if it plays out by that long end going up, that's the Treasury market saying, look, we think the coast is clear. We think that growth is going to come back, or maybe growth in inflation, nominal GDP growth, and the coast is clear. We see the sun coming up over the horizon, and this means that we're going to go ahead and start taking risk. These financial institutions, they're going to allocate their balance sheet capacity to taking more risk, i.e. lending, into the real economy as opposed to buying the most safe and liquid assets, and that would be U.S. Treasuries. And that's where you see the demand go down to the point where you see those yields go up. That would be a good sign. But we are seeing the exact opposite, where these financial entities are buying more and more of the long end, bringing down rates, and then they're really buying the front end, the 2-year, let's say, which brings the rates faster, bring those rates down faster than the long end. And that's basically, like Gunlock always says, the Fed usually just follows the 2-year Treasury. So it's all about probabilities, right? I mean, you saw a bull steepener that didn't pan out in 2023, but at that time, we didn't have the SOM rule being triggered, as an example. We didn't have the unemployment rate spiking. We didn't have all of these corporations coming out and saying that the consumer's completely tapped out. So when you take the data in totality, again, no certainties, but the probability is much, much higher that we are pretty close to a recession, although you never really see the recession or the hard landing until the Fed starts dropping interest rates.
Do you think that Janet Yellen, our Secretary of Treasury, is she making the distortions work on worse on the 10-year on the U.S. Treasury yield market by this Treasury bond, the U.S. Treasury bond repurchase program? Because didn't it double recently? Do you think that she's making it worse with these policies?
I know there's an argument for that. If she is distorting the market at all, it's not enough to uninvert the curve, or it's not enough to invert the curve to begin with. And I think that the treasury market's really weird, because if you just dumped a massive supply or withheld supply of gold, let's say, you would expect the price to be dramatically impacted. But the treasury market, you have to kind of step back and ask yourself, why are entities buying treasuries to begin with? Especially these entities in the financial market outside of the United States. And it isn't really, supply really doesn't impact their decision making. As an example, Jason, I always use myself because I live in Colombia. So I believe that, if history is a teacher, that the peso is likely going to depreciate over the next 5 years relative to the United States dollar. So what I'm going to do is I'm going to go ahead and buy treasuries. Let's say I buy a 1-year T-bill and or 2-year, and I just roll it over. If Janet Yellen issues another $2 trillion in 2-year bills or 2-year treasuries, I don't care. I absolutely could care less, because all I care about is the fact that I get my principal back plus interest. And then you say, well, George, the trouble with that theory is that that's going to devalue the dollar, and then those dollars are going to have a lot less purchasing power relative to the stuff that you want to buy. But this doesn't hold up if you just look at it and you scrutinize it on a chart going back to just when they started QE, as an example, because the argument there really is predicated upon the Fed having to come in and do QE and buy treasuries because the market won't. And so just look at the dollar as an example, Jason, since 2012. I mean, I don't have to tell you what it's done relative to other currencies, is it's gone straight up. The Fed took their balance sheet from, I don't know what it was in 2012, but it sure as heck wasn't what it is today. And then when you look at the overall debt, it's what we just crossed 35 trillion. And we look at the deficit to GDP, and we're running like wartime deficits. The M2 money supply went up by 25% in just a year, going back to 2020 and 2021. And with all of that, the dollar is still higher than most currencies. It's at 102, 103, which historically is pretty high for the USD. And so, we haven't seen the dollar impacted against other currencies as a result of the Fed increasing their balance sheet. And we definitely haven't seen it as a result of the government spending being completely out of control. If anything, we've seen the opposite. So the supply, or the lack of supply, which is the argument for the Treasury impacting the yield curve and making it inverted to begin with, I don't really think holds up under scrutiny. And then when you actually look at this ATI report that just came out with, I think Rubini, Nouriel Roubini was part of the group that put this out, and they were arguing that Janet Yellen is, in fact, impacting long into the curve to the degree to which it equals more stimulus. But even their conclusions, Jason, pegged the differential of interest rates at 25 basis points. So, even if the 10-year is 25 basis points higher as a result of lack of issuance at the long end of the curve, it still doesn't even come close to uninverting the curve. So bottom line there is I think that she may be, that may be an issue, but not to a great degree. And by no means would it invalidate the action that we've been seeing for the last 2 years in the inversion, and then the more recent uninversion due to a bull steepener.
Well, also the national debt's going to grow faster and faster. I mean, we're at a 1 trillion of debt added every 100 days right now. So if Yellen keeps this up or whoever replaces her in the next couple of years, the debt's going to keep growing at that pace, if not faster, even if the rates come down. I mean, I think it's just a math problem now where the debt's going to keep compounding on itself. So this is a long-term problem. The people in DC don't really see this as a problem right now, but in the future, it's going to be a problem because it's going to take up larger and larger chunks of the annual tax receipts.
Yeah, but that assumes that there's not going to be a buyer for the treasuries. And so let's go back to 2007, when the U.S. debt was about 9 trillion. So let's just round up and say it was 10. And then we fast forward to today. Let's see, we're 13, 16, 17 years later, and the debt is at 35 trillion. So back in the good old days, when the debt was only at 10 trillion, the 10-year treasury was trading right around 4.3%. Today, when we've added $25 trillion worth of debt, in other words, $25 trillion of additional supply of treasuries, the 10-year treasury is trading at a whopping, call it 3.9. So we can definitively say, that the massive increase in debt that we have seen over the past 20 years has not created a problem in the bond market as far as appetite for the market to absorb those bonds. Now, will it in the future? I don't know. But if someone's going to make that argument, they have to tell me how the global monetary system will change. Because if it doesn't change, then I don't see why that's going to be a problem. If 35 trillion isn't a problem, I don't know why 50 trillion isn't going to be a problem. But a lot of people hear me say that, and they think that I'm implying there's a free lunch. And I'm by no means saying that the government can spend like an MMT thing. I'm by no means saying that the government can spend without consequence. It's just the consequence isn't paid for in the bond market. That's not where the problem lies. The problem lies in the actual government spending. Because if the government's going to take the debt up to, let's say, 50 trillion, which I totally agree with you. Like, I totally agree. The deficits are going to blow out, and, who knows? We could get to 50 trillion in the next 5 years.
Especially for commercial real estate bailouts. I mean, I heard that they were already planning the bailouts in the last 6 to 9 months, but they were hoping to get them done after the elections in November.
Yeah, so all those bailouts and all that government spending is going to create further economic distortions. And those economic distortions will result in lower productivity. And that lower productivity will result in the standard of living for the average Joe and Jane declining. So that's where we have to pay the price for the debt. It's with the government spending creating those malinvestments and the misallocation of resources. It isn't really with the treasury market unless we have a fundamental change in the monetary system. And if people think that fundamental change is going to come from a BRICS currency or them trying to use gold as collateral in the Eurodollar system, I think the probability of that's very low.
Okay, so it sounds like with all the rules changes, bailouts, all the goalposts moving, that you're in like the stagflate tax lie camp, or the real inflation rate is going to be higher than what the consumer price index, or as you say in your video, CP lie, or I call it changing propaganda index. So it's some type of real inflation rates above the official government inflation rate, but you're not in what you described. It sounds like with all the rules changes and lever pulling and stuff like that, the U.S. Treasury and the Federal Reserve Bank in D.C., they can avoid like a dollar collapse. They can delay it for many, many years. They can avoid hyperinflation, and they could just keep exporting a lot of the monetary inflation or focus on asset price inflation. Because wouldn't you argue that they've been inflating asset prices with the S&P 500, a lot of stocks and home prices for decades now?
That's a tough argument to make. And the reason I say that, Jason, is because if you go back, well, let's just not go back to 2008. Let's go back further. Let's go back to, let's just say 1980. If you look at the amount of bank reserves on the Fed's balance sheet in 1980, it was around 40 billion with a B. And then if you fast forward to 2007, the amount of bank reserves didn't change. It was 40 billion. So the Fed from 19, and you can even go back to 1950, but we'll just go back to 1980 to 2007, basically did nothing as far as their balance sheet. They literally did zero. But if you look at the stock market from, let's just say 1980 to 2000, it went up to a much greater degree as far as in percentage terms than from, let's say, 2008 to 2021. So I find it hard to make that argument that the only reason why the stock market went up was due to QE, because it went up a lot more when the Fed didn't do anything, when they just kept their balance sheet the exact same. So I think there's a lot of variables there, and just that analysis would make me dive deeper and say, wait a minute, there's probably something else going on here that is a bigger contributing factor than just the Fed's balance sheet, if the Fed's balance sheet is a contributing factor at all. And I think there's a really good argument that it's actually counterproductive from the standpoint of the real liquidity for the financial system, ironically enough, and I don't like this, but it is what it is, are T-bills. So I think they're far more liquid, or far more useful, I think is maybe a better word. They have more utility than bank reserves themselves. So if you're really thinking about, okay, what drives liquidity? Number one, and first and foremost, I think it's just perceived counterparty risk. But then number two could be the amount of T-bills that are actually in the system. So by the Fed doing QE, assuming they're buying bills, then you could argue that's actually taking liquidity out of the system, and the stock market would have been even higher if they wouldn't have done QE to begin with.
That's interesting, but it seems that every time a lot of these other central banks cut rates or do a liquidity program, a lot of the liquidity from portfolio managers, so institutional investors, ends up in like US stocks or other US assets, maybe US treasuries, that the liquidity from other countries ends up here.
Yeah, I think it's more psychological than it is mechanical, because what that implies is the central banks control liquidity instead of the commercial banks. And I would argue it's vice versa. It's all about the commercial banks, and that argument really revolves around commercial bank balance sheets being constrained somehow, as if they have more reserves, whether it's in the European Union or wherever, that they can somehow lend more, and that's a fallacy. The additional bank reserves don't give them the ability to lend more. They can create those loans with or without reserves. They can create those loans with or without cash. And then if someone wants to get sophisticated, they say, yeah, but they can't settle with other banks, interbank, by transferring those deposit liabilities. But they can do that as well, just by the extension of credit from the receiving bank to or from the receiving bank to the sending bank. So, and this is why you see in the banking system outside the United States since the 1950s, the amount of dollar loans just went exponential. And that was a result of the market having to find a solution to Bretton Woods, where there wasn't enough dollars coming out of the U.S. in the form of a trade deficit. And therefore, the banks said, well, we don't have enough dollars, and we have all this demand for dollars. So we're just going to create our own. And it's just simply a balance sheet type of transaction where you just create a dollar loan and the offsetting asset is just the loan that you created. And then when you have to transfer that deposit liability to another bank, they just extend you dollar-based credit. And therefore, you have an entire banking system outside the United States that really doesn't need reserves and they don't need cash. So that's why, if you start from the premise of the balance sheets outside the United States are only constrained by risk and not constrained by anything that the central banks can produce mechanically, then it takes you down a much different path.
So you don't think the Fed keeping interest rates this high is breaking banks in other countries, like with the fifth largest Japanese bank in the video that you made with them being the collateralized loan obligation market maker? Because they don't seem like a very large bank, and yet they're a market maker for these CLOs. It just seems like they added way too much risk.
Oh, I completely agree with you there. But I think they're doing that absent the Fed. And I do think there's a much better argument for the Fed's manipulation of interest rates to cause economic distortions than their balance sheet. So I want to be clear there. That last 10 minutes that we were talking, I was specifically talking about the central bank's balance sheet and not really their manipulation of the front end or the short term interest rates. So yeah, let's now fast forward to what you're saying there. When the Fed jacks rates to 5.25%, which it's funny because a lot of people think that the Fed always has interest rates artificially low, but I don't think that's true. Because if they always had interest rates artificially low, I don't know that we'd have an inverted yield curve ever. The fact that we do have an inverted curve may, and I'm not saying it does, but it may imply that the Fed has interest rates artificially high, to your point. So anyway, yeah, this just completely destroys Japanese banks that have to roll over this short-term dollar debt. And, they can go ahead and buy all these treasuries, let's say, back in 2020 and in 2021, when their borrowing costs for dollars are, let's just say 1%. That's not an exact number, but just for the sake of example. And then they're just getting like a 3% yield on those treasuries and they're pocketing the 2%. Well, that works all day long until they have to start rolling over that short-term debt. Those dollar funding costs go from 1% up to 5%. Now, all of a sudden, you've got a negative carry, and just like Norinchukin Bank, you have to unload. I don't know how many treasuries they unloaded, but they had to take that $10 billion loss. And it's not because they wanted to sell the treasuries, it's they had to, because they just had this negative carry every single month. So they had to go further out the risk curve to try to find some sort of yield that was higher than the liability side of the balance sheet, those dollar funding costs. So to your point, the only game in town were CLOs. So they have to go out and buy these derivatives where the underlying asset is like junk corporate debt or commercial real estate in the US. So I think a lot of what you've been seeing the last couple of days in the markets has just been a realization that these big Japanese banks could have many, many, many more problems under the hood, and they may go bust, and that could have some serious systemic risk. And another thing that I haven't heard too many people talk about is the fact that the credit spreads have been incredibly narrow, but that could have been a representation not that the economy is healthy or that the underlying assets or the underlying debt is solid, but maybe more so that all these Japanese banks were buying that credit because they had no other choice, and they're buying that credit or buying that debt via these CLOs. So now that we start to see credit spreads, blow out, then all of a sudden, that's blowing a hole in these Japanese banks' balance sheet that had to load up on that extremely risky asset, that derivative. And that might be, Jason, why you saw a lot of these Japanese banks were down by like 25% just in the last few days as far as their market cap. And when you saw the Nikkei rebound by like 10%, the Japanese banks didn't rebound near as much. And they're still down. And that could be the market kind of waking up to these problems that they have on their balance sheet, which again, if it's not isolated to Japan, because when people understand the global monetary system, you realize that it's just a network. It's a network of all these banks' balance sheets. So if you have these banks in Japan blow up, that will affect the network, and therefore the banks that are located in other areas, including the United States, which will impact liquidity far more than what the Fed is doing with like QE or QT.
I've seen a lot of red flags, a lot of evidence that a lot of these banks have enormous amounts of losses that they have not marked to market yet. The Japanese bank that you mentioned, I mean, they had a much larger loss on their older U.S. Treasury bonds. It's probably even larger than that. They have losses on CLOs. I think we're going to start to see mark-to-market losses on a lot of banks. The Chinese banking system, over 40 Chinese banks got bailouts. They were just rolled up into larger banks. So the Chinese government is totalitarian and centrally planned, but I'm guessing they had real estate losses with the Fed raising interest rates. They had dollar-denominated debt problems. So I think a lot of the loan books for these banks, whether it's commercial real estate loans, consumer loans, small business loans, auto loans, there's a lot of losses there coming. And then the biggest one, the newest piece of news is Warren Buffett. I mean, he was dumping Bank of America shares the last 14 days at a record pace.
Yeah, and Apple, right?
Well, I mean, Apple's like discounting now. They have too much inventory. They've been doing financial engineering with their balance sheet with share buybacks and stuff. But I was talking about like the banking system, like Bank of America. Didn't they write off like a couple $100 billion in older U.S. Treasury bonds? They wrote them down.
I'm not sure, but I did a video on this the other day, Jason, and I'm trying to remember the exact numbers as far as unrealized losses. And for your audience, I know they're rather sophisticated, but for the people who might be a little newer, the asset side of a bank's balance sheet has several different compartments, but one of the compartment is hold to maturity. So those are the assets that you're referring to that don't have to be marked to market, because if we have a treasury that's 1 year maturity and we're going to hold it to maturity, it doesn't matter what the price is doing in the interim. That's the argument there. So what the problem becomes when these banks are forced to take what is in that hold to maturity bucket and actually bring that down to where they have to sell it. And that's where the unrealized losses become realized losses. And they can be forced to do that many different ways. I mean, Silicon Valley Bank, you just saw deposit flight. Norinchukin, you just have a negative carry. And there's just, I mean, we could go down the list of all these reasons that could force the banks to turn those unrealized losses into realized losses. And that it could be exactly what Warren Buffett is seeing with Bank of America. I read just today that he has more T-bills now than the Federal Reserve. Warren Buffett does. So
I'm not shocked. I mean, like he's getting almost 5%, quote unquote, risk free for loaning the U.S. government short term. So he can wait for if there's a stock market crash, he has cash, then liquidity to go and buy things that go on sale.
Yeah, that's right. I mean, it's really difficult as someone who has their expenses denominated in dollars. It's far, far easier if you have your expenses denominated in another currency, because then you can hold liquidity in US dollars, and and you can not worry so much about that impacting the purchasing power or your purchasing power for the stuff that you have to buy daily. Right. But if you're a U.S. citizen, you don't have that luxury, because the inflation rate in the U.S. is still running at, let's just say 3%. Well, the headline is still at 3%. And as you stated before, it's probably a lot higher than that. I think the CPI is useful in seeing the trend, but I don't think it's useful in seeing where the outright inflation, the true rate of inflation is based on what people actually have to buy on a daily basis. But if, like the dollar, as an example, Jason, if you're a Japanese investor or Brazilian or Malaysian or Colombian, I mean, there's a lot of these bigger economies. It's not just Argentina and like Turkey or something like that. But since 2012, the dollar has appreciated relative to your local currency far more than the local inflation rate. So what that means is you have been gaining purchasing power by holding US dollars. So that's a fantastic kind of, I hate to call it a store of value, but it has been for those individuals. But obviously, it has not been for people in the United States. The only option they have there is for something like gold or maybe real estate. But now that's in a massive bubble as well. So it puts people into a bind. But my point there is that with the United States dollar, if you've got your expenses denominated there, you've got to look around and say, well, what can I do? And usually treasuries are your safest bet, but you're losing purchasing power to the stuff that you want to buy every day, unless what you want to buy are assets. And to your point, if you want to buy assets, then those dollars can appreciate in value very, very quickly, like we've seen over the past couple months with the stock market going down.
Well, I was going to talk about your videos where you went on a trip to Argentina and you were showing that boots on the ground, that there's still strong demand for dollars in a lot of these other countries, that they view the dollar as very much stable compared to their domestic currency.
Well, it's not just to their domestic currency, Jason. It's because that's the argument here, is that, yeah, the dollar might appreciate against other currencies, but it's just the cleanest dirty shirt. Or yes, the dollar is appreciating against other currencies, but it's just going down at a slower, it's just losing value at a slower rate. No, it's not. No, it's not. That is true for Americans. That is true if your expenses are denominated in dollars. But for Argentinians, for Malaysians, for Indians, for Japanese, that is not true. That's not true. The dollar has actually gone up in value relative to the stuff you have to buy every single day. If you go back to 2012, and I always go back there because I think that's a huge shift that we had in the global monetary system as far as global denominated debt, which has put in this ultimate bid for the dollar, because there's so many dollars that are created by lending them into existence as opposed to actually being printed. And at the end of the day, that makes a lot of difference, because the demand for dollars actually controls the supply to a significant degree. But going back to that person in Argentina or a lot of places outside the United States, yeah, they see the dollar quite literally as gold. And when I was going through Argentina, the very first place that I stopped when I went over the Andes Mountains, because we drove from Santiago, Chile, I stopped at this little food stand or whatever, and they were exchanging dollars into pesos or vice versa. And they spoke some English, and they literally told me, Jason, that when we were exchanging these things, I was talking to them about the dollar and how they see it, and they said this green piece of paper for us is like gold. They literally used that term. And the challenge going across Argentina driving was to try to make the whole trip from the far, what would that be, west side to the east side, to hang out with Doug Casey in Buenos Aires. And we had gold, silver, and Bitcoin. And what we found is that the gold was very illiquid, very tough to sell. And we were trying to sell it for not dollars, but Argentinian pesos, just to pay for hotel rooms and gas and food and whatnot. And the silver was a lot easier. But the silver was still pretty difficult to sell, and we were going down into the city center and trying to go to the jewelry shops and the coin dealers and the currency exchange, the cambios is what they call them. So we were in the right spot. It's not like we were just going to random strangers on the sidewalk. And then what we found was Bitcoin was almost impossible to sell for the local currency. And some people got confused. They said, well, of course, no one's going to take Bitcoin, because they want to save it. I'm like, no, you don't understand. We were trying to sell Bitcoin for depreciating Argentinian pesos, not just depreciating, but hyperinflating Argentinian pesos. And people didn't even want to make that trade. So the only thing that we really, and we found a couple places in Buenos Aires that would do it, but the couple other places that we found in other cities that would even think about taking crypto, they wanted Tether. So we had to take the Bitcoin and buy Tether with it, and then we had to sell the Tether to those individuals for the local currency, and then that's what we would use to pay our expenses. And there's no way we could get dollars, because people just hoard those dollars like they're like it's life and death.
I guess people want to save up dollars because they view it as stable, and then maybe they want to plan a move because the United States is still looked at as favorable to move here if you're from an emerging market.
Or they just hold on to the dollars because if they have recency bias, of course, and over the last 12 or 13 years, if you held dollars in those, you made a lot of money. In other words, I shouldn't say you made a lot of money. I should say you increased your purchasing power dramatically in terms of local goods and services. So, and oddly enough, especially in Argentina, when they have a failing banking system, it creates this environment where nothing is liquid. Like cars aren't liquid, houses aren't liquid because nobody wants to put money in a bank. So everything is just cash, 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 cash. And in that environment, like literally nothing has liquidity except for that cash itself. And then the ultimate liquidity is USD, and not just USD, it's $100 bills. And the way you know this is because the exchange rate that you would get on the black market for $100 bill was much, much better than a 50 or a 20.
Especially because in the Argentinian banking system, I think it was like 20 years ago, their last hyperinflation, or 25 years ago, they actually froze the bank account. So if people had US dollars in an Argentinian bank, the government confiscated the dollars and forced conversion to official government exchange rate of a devalued Argentinian peso that they were hyperinflating. So I'm sure
That's right.
people, so
That's
I'm
right.
sure.
That's absolutely right, Jason. And now people are just super. I mean, they're almost doing the same thing now from a stand. And I don't know what Malay's done because I wasn't there when Malay was in office, but or maybe I was, but he would have been brand new. But they're almost doing something similar, Jason, where they only allow you to take out $40 a day. So that's another reason why no one wants to use the banking system, because let's just say you deposit $10,000 worth of Argentinian pesos. Okay, great. Well, now you can only get $40 a day.
That's
So,
weird.
so,
You can't do
so,
normal transactions then.
and not only that, but think about how long it's going to take you to get those pesos out of the bank in order to buy dollars that won't depreciate. By the time you get all those pesos out of the bank, they've lost like 90% of their purchasing power. So it's just
Well,
it's a
did you
complete quagmire there, but that equals no liquidity for anything, including gold and Bitcoin, unfortunately.
Well, speaking of gold and Bitcoin, did you see the one of the last presidents, Kirchner? Like, she didn't go to prison for this. She had billions of dollars hidden in mansions. Literally, there were dollars and euros and gold bars stacked to the ceiling. She had USB drives with Bitcoin too, and she didn't go to prison for it. So she had billions of dollars of stolen cash,
Yeah, I mean
stacked
that's the
stacked to the
it,
ceiling in
look.
mansions.
If you want to break the law, the best thing to do is be a politician, because it's the only gig in town where you are effectively above the law. I mean, every once in a while, a politician might go to jail, but it's extremely, extremely rare, especially in the United States. So that's why it attracts so many criminals.
White collar criminals, George, they have law degrees now, and they're hedge fund traders. Our best hedge fund manager now, I say jokingly, is Nancy Pelosi.
Yeah, yeah. It's funny. I just did a video with Patrick Seresna from Macro Voices, who is an expert option trader. And one of the videos he just released on his new YouTube channel, he outlines how Nancy Pelosi uses options to express the bets that she makes because of the insider trading or because of the insider info she gets.
Well, I've been at parties here where government employees pull out their phone and they have like almost $2 million of trading accounts on their phone. So, and they make it like it's no big deal and say they're not rich. So this is kind of how ridiculous things are. And people talk about stock tips that 10, 15 years ago would have never talked about it.
Yeah, and it's not like they're geniuses. It's just simply they have access to insider information that should be illegal.
Bingo. And they're selling the information too. I mean, there's a Goldman Sachs, I think, headquarters now here in DC. I mean, the information is bought and sold. People aren't losing their top secret security clearances like no government employees. Look at the scandal with the Trump stuff. I mean, like the head of the Secret Service, I don't think she's going to get any um serious criminal charges for any of that. There's just government blunders all the time that no one goes to prison for felonies.
Yeah.
Well, I want to ask you now, if the Fed does start to cut rates in a panic move, do you think that this is going to fix commercial real estate, residential real estate here in the United States and other markets?
No, because what happens is usually by the time the Fed starts dropping rates, it really doesn't matter because money's tight. So people conflate cheap money with loose money. And it's very rarely true, because if the rates are at zero, excuse me, let's say, that might be cheap money, but what that implies is the economy is so unhealthy that the banks are going to be unwilling to lend. And so a lot of times cheap money is actually tight money. So a lot of these real estate investors sit back and say, oh, well, this is no big deal. I'm going to be bailed out because the Fed's going to drop rates. Well, you got to be careful what you wish for, because even if those rates are low, it doesn't necessarily mean that you can get a loan. And I'm a perfect example of that, Jason. When I first started investing in real estate, that was 2012. And I was buying these single family rental properties in Kansas City with cash, no leverage at all cash. So I built up this really nice portfolio, and it's not like these were in the hood or, C properties. These were A and B properties in the best school districts in Kansas City. And I had renters in all of them. And then I take this portfolio to the banks in Kansas City, and I didn't even ask for a cash out refi. I only asked for a line of credit. I was asking for a line of credit, 40% LTV. Not 90, not 80, not 70, 40%, 40% LTV. So the banks, or the value of these properties, could go down by 60%, and the bank still would not have taken a haircut. And I got rejected every single time. But yet rates were at zero.
That is so weird, considering they give out, like they were giving out back then, FHA loans in 2011, 2012, 2013 like candy to first-time home.
Yeah, but it was reduced. Yeah, so normally they would let you do up to, the FHA, I think that's first time home buyer. But for the investors, I know those Fannie loans, they narrowed it down to where you could only do, it was 4 or something like that. Then they expanded it to 8 or so. But what you're saying there, it's got to be subsidized by the government. It's got to be guaranteed. Those are not loans that the banks are making that are keeping on their balance sheet. And if they are keeping it on their balance sheet, they've got a guarantee from the government. So I'm talking about loans where there is no government guarantee. Those are the ones that are going to dry up really, really fast, regardless of what interest rates are. And the lower interest rates go, the more that gives you a signal that the economy is unhealthy. And the more that gives you a signal that the perceived counterparty risk in the banking system is increasing. Therefore, liquidity is drying up in everything other than what the government, or in other words, the taxpayer, is guaranteeing.
Well, also with real estate, I see a cash flow problem, and I see fundamental structural issues with the economy, especially for commercial real estate. Because as you know, with a real estate investor, most people with real estate use debt. They use a mortgage, whether it's commercial real estate or residential real estate. So they have certain cash flow projections that they need in order to pay off their monthly mortgage payment, their property taxes. And then as a real estate investor, you know that like once all those expenses are subtracted, the difference is your monthly profits. So I just see that the cash flows that a lot of people were expecting for commercial real estate, for renting out like buildings, for restaurants and retail and office space, those things are not there due to structural changes in the economy with work from home, or just companies shutting down the amount of locations.
Yeah, and it's a great point, Jason. And think about the knock-on effects, right? We talked about that earlier. Because a lot of people get too myopic and they don't think about the unintended consequences. They don't think of the third and fourth order effects. So you're talking about commercial real estate going bust. So a lot of people would say, oh, well, that's bad for the commercial real estate sector. Well, yeah, but who else is it bad for? Say, oh, well, it's going to be bad for the regional banks. Okay, now let's keep going. Let's keep going. Well, what is the underlying asset of a lot of those CLOs? That would be commercial real estate. Okay, well, who owns those tranches of the most riskiest part of the CLO? That would be the Japanese banks. So it's not just a problem for, real estate investors in the United States that own an office building. No. That goes all the way up to Japanese banks, which creates massive systemic risk for the global monetary system. This is exactly why we could have a real estate problem, a U.S.-centric real estate problem in 2008 that blows up, and it causes a global financial meltdown. How is that possible? It should have been just not to use Ben Bernanke's words, but it should have been just contained to real estate. Why is it that we just have every single financial entity completely melt down? Because they're all interconnected. All of these balance sheets are very, very fragile. This network is fragile, and it just has been running on hyperdrive since the GFC and even before. But the problem, the fragility that we had during the GFC has only gotten worse because now we have a lot less collateral to support the system. Where prior to the GFC, we had mortgage-backed securities and we had T-bills. We had other things too, but that was the majority. And now we don't have those mortgage-backed securities, or else they're frowned upon. You take a bigger haircut for using them. So ideally, you just have T-bills, and then you're competing with the Fed, and you're competing with Warren Buffett, for heaven's sakes. And so that takes it away from those financial institutions. But that's what people really have to realize. It's an interconnected system, and if you start impacting the balance sheets of the banks, even if they're outside the United States, that is going to come back and impact the U.S. economy to a significant degree.
And I think George's point here is that the American banks have counterparty exposure to these Japanese banks, to these European banks. Deutsche Bank just announced large commercial real estate losses. So there's counterparty exposure here that we're not getting a lot of information on yet. And the losses are not being marked to market yet, but they're coming.
That's absolutely right. In fact, when I was talking to Patrick today, Jason, he said, I guarantee you somebody or multiple entities blew up over the weekend as a result of what happened. We don't know who, and we don't know, we don't know if it's a hedge fund. We don't know if it's outside the U.S., inside, but I can assure you some entities blew up, and we'll have to see how much systemic risk is out there. What we saw Thursday, Friday, Monday is by no means the end of it. Just like what we saw in March of 2023 wasn't the end of the banking crisis. And, everyone thought that the BTFP just fixed everything. No, it didn't. That's why we still have these issues in and outside of the United States with these banks.
Yeah, it's all these leveraged bets. So it's the Wall Street derivatives machine with all these derivatives. The major trade that a lot of people haven't talked about, and Christopher Cole of Artemis Vol, like he's not managing money anymore. Like his hedge fund shut down in the last 18 months. It was a leverage short volatility trade. He was saying for a long time, and I know you interviewed him a couple years ago, it was over $3 trillion in size. And now here we are today. The VIX just spiked over 27. I mean, those are margin calls for the hedge funds and the bank portfolio managers that saw this leverage short vol trade selling volatility as an income product.
Yeah, that's right. And when you look at, going back to the yield curve, what that tells you, it never tells you where the blow up is going to be, or to what extent you're going to see blowups. But the way I look at it, Jason, it's like a game of whack-a-mole. So if you're sitting there playing a game of whack-a-mole and you're like in the easiest level, those mole heads like pop up like once every 5 seconds. So it's super easy for the Fed to sit there and whack them down, right? That's indicative of the beginning of the inversion. But then as you go a year into the inversion, 2 years into the inversion, and then you start to see that bull steepener happening, and then the 2s and 10s uninvert due to a bull steepener, we're still playing the game of whack-a-mole, and to the point where the person playing, let's say the Federal Reserve or the government, they haven't missed a mole yet, but instead of the moles popping up once every 5 seconds, now they're popping up once every half second. Bam, 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 until finally you inevitably miss one of those moles, and then you have, take it to an extreme. You have a meltdown, you have a hard landing, or at the very least, the economy goes into recession. So that's why when you see Jim Cramer, when you see all these people on FinTwit and on CNBC, they say, well, this time it's different. This time it's different. This time it's different. There's no sign of a recession whatsoever. That's right, because the Fed or the central planners, they haven't missed one of those moles yet. But that doesn't mean that the moles aren't coming up at a much more rapid rate, which every single time you notch up to the next level as far as speed of those moles popping up, it's going to increase the probability that you do have that hard landing until it inevitably comes. And that's what the market misses. Just because they haven't missed a mole yet doesn't mean the probabilities aren't skyrocketing.
Well, also DC spending, the fiscal budget for 2025 is over $8 trillion into the economy. I mean, if DC is going to spend that much money, I mean, it's going to be hard for an official recession. They've been delaying things, at least 2 years. If they're going to keep spending many, many trillions of dollars into the economy, it's going to hurt the private sector, but then it's not going to be an official recession then because of just how much the government is spending and handing out in social transfer payments and stuff.
That's a catch-22, because in my view, it is absolutely true. What you're saying is that short term, that kind of adds let's say a buffer to GDP because that government spending is calculated in GDP. But longer term, I would argue that just increases the risk of not just recession, but increases the risk that we will have multiple recessions, because what's happening there, it goes back to government spending and the economic distortions that just crush productivity. And at the end of the day, productivity is wealth, and productivity is the standard of living for the poor, middle class, the average Joe and Jane. So if you take what you're saying there, and if we go into a recession, and if the government starts spending more and more money to paper over it, then what's going to happen is government spending as a percentage of GDP is going to increase significantly. And when you look at federal, state, and local, we are I haven't checked on it in a while, but we were darn near 50%. 50% of economic output for the United States is a result of government spending. In other words, is a result of something that's going to create distortions, malinvestment, and misallocation of resources that will sedate the economy over the long run, even if it, quote unquote, stimulates the economy in the short run.
Oh, yeah, I totally agree. It's just more misallocation of capital, grows the debt faster. And then the best case scenario going forward long term is worse stagflation, because then the system with fractional reserve banking and the banking system problems with the derivatives, the central planners in DC do not want to allow deflation because they know if one large bank fails, it could start causing contagion and a domino effect to take the other banks with it.
Yeah, but the Japanese didn't want deflation either.
They were the only one doing it for 30 years, though. They were only
for you.
They allowed
the
yen carry trade was a funding that allowed asset price inflation too. I mean, there was a ton of hedge fund managers and bank portfolio managers that have been using the yen carry trade for funding investments in a lot of other countries for years.
Yeah, I don't know if the result of all the government spending is inflationary, deflationary, disinflationary. I think there's a strong argument for all of them. I just know that it's going to reduce the standard of living because it's going to reduce the productivity due to government becoming more and more a player in the overall economic output. If you just take it to an extreme, look at communist Russia. You know, there the government, accounted for 100% of GDP, and look at how efficient that economy was. And what's interesting about that, Jason, is we growing up see all these photos, black and white photos of the Russians in the 1970s or whatever, and these bread lines. And we as Americans assume it's because they didn't have any money. It's not because they didn't have any money. They all had money. They all had plenty of money. They just didn't have any stuff. They didn't have any bread. There was nothing to buy in the stores because the economy was so inefficient, it couldn't produce anything. That's what we have to remember, that wealth or purchasing power is not a result of just having more money or gold or Bitcoin or anything. It's a result of having more stuff. That's what increases wealth in society and therefore increases the standard of living. And so whether that we get to less stuff in an inflationary way, disinflationary way, or deflationary way, the net result is still the same.
There's less free markets, though. I mean, I think there's tons of manipulations and distortions. I would argue, I think the oil price is capped intentionally until after the election. I mean, even with all the geopolitical risk coming out of the Middle East, I mean, the oil price just looks like it gets slammed and smashed all the time. With the early morning futures, it kind of reminds me of what's been happening in the gold market for a long time up until the last 6 to 9 months when it looks like gold finally started to break free.
Yeah, but that is consistent with what we're seeing in the yield curve. So I'm not saying that there is not manipulation there, but it is consistent with a lot of the economic data that's coming out now. The jobs report that we just got that was 114,000 instead of 185, which I guarantee you, oh, I shouldn't guarantee, I can almost guarantee you is going to be revised down next month, like they have pretty much every single time for the last year and a half. But all that would lead me to believe that oil would be going down regardless. And in fact, I just listened to a guy on Macro Voices that was talking about doing the back of the envelope math on where the oil price would be without the almost unprecedented production cuts that we've seen out of OPEC. And he pegged it at sub 50. And so
That's
I
funny
didn't,
because no one can make any money sub 50. I mean, like most of the shale drilling would be shutting off and bankrupt. So I don't know who's saying that, but like he doesn't understand production costs.
well, no, temporarily. Temporarily it can go far below the level of production. I mean, we saw that in 2020 when it got to negative $38 a barrel. So I think that's more so what he's referring to. And I do think that longer term, we're in a commodity super cycle for sure. But that doesn't mean that prices just go straight up. And
Oh
so
yeah.
I think that you could see some disinflationary or deflationary pressure in the commodity space if we go into a recession while we see this yield curve play out or uninvert, the Fed drop rates, the same cycle that we've seen pretty much for the last 40 or 50 years, the stuff hitting the fan. But coming out of that, that's usually when you see commodities, gold, just rip higher. And I would expect to see the same thing in this cycle.
It looks like the other central banks are starting to cut rates and go to kind of some kind of yield curve control or adding liquidity to the system first. Is that what you see as well with the G7, the other central banks?
Well, they're definitely cutting rates. I don't know if they can really control the interest rates at the long end of the curve. I mean, the Fed tried to do that with QE 1, 2, and 3. And by buying all those bonds, they actually made interest rates go up, not down. It was the opposite of what they wanted. So they, I don't know. I don't think they control liquidity, and I definitely don't think they control at least the long end. Although I think they distort it. So that's why I always say end the Fed for sure, and end all central banks because we need free market interest rates. But yeah, they're to your point, they're in a rate cutting cycle. A lot of these banks, and I would assume that the Fed would follow suit. I don't know how you go into a global recession without the United States participating in that recession. And then it gets really, then you got to use a lot of game theory, Jason, because if these other central banks are having to cut rates, that's assuming that the United States doesn't or cuts slower, then you get the impact of interest rate differentials. And as you know well, that's most likely would make the dollar shoot higher, way higher. Now you're talking 110, 115, 120 on the DXY. And then that's going to blow up a lot of these economies with dollar denominated debt, or even, like a Japan that has to import so much of their energy that is denominated in dollars. And that becomes not only, it starts with, so what, that's your problem from the standpoint of the United States, right? The strong dollar, that's Japan's problem. That's India's problem. That's Brazil's problem. But it gets to a point because we're so dependent on our trading partners that that's our problem as well. And so I think, the Fed might ironically have to cut rates just to bail out other countries due to the potential impact to the United States. But I think that the DXY would have to be much, much higher. But I think that's something that we need to watch out for as we go into this rate cutting cycle with other central banks.
You don't think the Fed will start to give out like currency swap lines and not tell people? Because I think there's evidence with some of the press releases, Janet Yellen's visit, she went to Japan after she went to China. It looks like there was some type of that they expected problems in the Japanese banking system over the last 6 to 9 months. And then there was a press release in the last 6 to 8 weeks, I want to say, about like some type of the US and Japan. They approved some type of coordination there. It looks like the Bank of Japan may have gotten some type of currency swap line even though they spent what $100 billion in the last 3 months trying to defend their currency exchange rate, but they probably needed even more than that in swap lines.
Yeah, and keep in mind, it's up to the banks to lend. Like let's say they've got dollars. Okay, great. It's up to the banks to go ahead and lend those dollars. And if the banks don't see the risk reward making sense because we're in a recession, they're not going to lend out those dollars. Even if they do have, the central bank, has access to that dollar swap line. So, and that also doesn't really solve the problem of the dollar appreciating in value, right? So if the dollar goes from, let's just say, we'll use the yen. What is it right now? Maybe 147, something like that. Let's say it goes to 200 or 250. Now, what are they having to pay for oil in yen terms, right? I mean, that's what are they having to pay for food in yen terms? I mean, that is absolutely devastating. Even if they do have access to dollars, they don't have the dollar cash flow coming in from their productivity to be able to afford all of those things that they need on a daily basis. And they blow up. They blow up. Not to mention their inability to service their dollar denominated debt with their yen cash flow, because the burden of that dollar denominated debt becomes so extreme. So there's a lot of reasons why I don't think those swap lines would bail them out or solve the problem, even though it might be a temporary buffer.
And it looks like they're not going to be raising interest rates. But I've been saying for a long time now that they should actually, and it would piss off Washington, D.C., which is probably why they won't do it since they're in the G7, that they should be buying gold tonnage. So if they want to defend their currency, historically, what governments did is they added more gold rather than raising interest rates. So I guess they could also raise interest rates. But since Japan has so much debt, they could just be buying more gold tonnage with their trade surpluses, and then that would strengthen their currency over time.
Yeah, Brent thinks, I talked to Brent yesterday, and he thinks that they're going to do a 180. And I'm talking about Brent Johnson. He thinks that he says his base case is that within the next, whatever, couple months, that the BOJ says, sorry, we're going to go ahead and cut rates back to zero. And so talk about getting egg on your face.
Well, I think with the yen carry trade, from what I understand, because I've been interviewing hedge fund managers for the last 6 months about this, and they were predicting the blow up, is if the borrower and the lender both have too much volatility in the loans, then they start to have problems. So you've had so much volatility in the yen exchange rate that has caused problems for both the lender in the yen carry trade and then also the borrower.
Yeah, absolutely. You get that margin call, and the lender wants to cover their ass, right? And so then that's going to force the borrower to sell at a time that just blows a hole in their balance sheet. And, it could bankrupt them. And then they can't pay all the other lenders they owe. And then that blows a hole in their balance sheet. And this is at the exact same time when they've loaded up on CLOs over the last, let's say, 6 months. And those corporate credit spreads are going through the roof. And the commercial real estate market is tanking, which is the underlying asset for those CLOs. So you get a double whammy on those Japanese banks' balance sheets where they're not being paid back those loans because the borrowers are going bust, and they're having to write down those risky assets, the CLOs, because the underlying asset for that derivative is tanking as well.
Well, also, whoever's using the yen carry trade as a funding, they're going to sell their profitable trades if they get a margin call, like you said. So they're going to be selling what Mag 7 or NVIDIA shares if they have profit. They're not going to be selling because they want to. They're going to be selling because the bank says, oh, you have a margin call in your other trades. You have to sell something profitable. So they're going to sell their gold. So they're going to sell their Mag 7, their NVIDIA shares. They're going to sell their big tech stocks. They're going to sell their gold positions probably.
Great point. Great point. You know what thing I still really haven't been able to figure it out, because you would assume with that yen carry trade, they would have gone into treasuries heavily. And you saw the price when that trade was unwinding, you saw the price of treasuries go up, not down. So maybe it's just because they were going so far out the risk curve that they stopped buying treasuries, like a year or 2 years ago, and they just went all in on Mag 7. That could be what we saw. But I just thought that was interesting, because that unwind, I would have assumed that treasury prices would have gone down as well.
Well, the funny thing, we haven't seen any evidence that this is going to happen the next couple of months or anything like that. But I mean, I've spoken to a lot of hedge fund managers the last 2 years, and they keep telling me all the bad things about SoftBank. So they're not actually a bank. That's like the largest like investment manager in Japan, and so they were basically floating junk bonds to go and buy like technology company shares in Silicon Valley and in China. And they also this is like anecdotal. I heard this from someone living in like San Francisco and Silicon Valley. Like they were buying like enormous amounts of Silicon Valley office space and collecting like commercial real
Oh,
estate cash
geez.
flows. Yeah, to like the unicorn. So they were like making tons of like rent premium at high prices off these Silicon Valley unicorns that were unprofitable and kept raising more and more money from like, venture angel investors, venture capital at the different levels. And so SoftBank was collecting like cash flow at all the different levels there from Silicon Valley unicorns for equity shares and commercial real estate rent. They haven't blown up yet, but I mean, like next year or two, I think that's like something to watch.
Absolutely. Absolutely. Maybe that goes back to what Patrick says. Says somebody blew up. We don't know who. Maybe it's SoftBank. It's just think about the late 1990s. Think about what happened to LTCM. Just one hedge fund that blew up that almost brought down the entire system. So you think the system now is less fragile? Of course not.
Oh, it's worse. Look at all the derivatives that Wall Street created the last couple decades.
Yeah, absolutely. Absolutely. And I think to the point that you're making, and hopefully your audience picked up on that because it was a great point, is that all these banks' assets, not all, but a lot of these banks in the monetary system, their assets are just the liabilities of the other banks and vice versa. so,
Well, but
so
SoftBank's not a bank though, so that's misleading. So they're called SoftBank, but they're not actually a bank. So they actually raise funds, and they're kind of more like BlackRock, where they make these weird, exotic, illiquid investments. They run like private equity firm or angel investors. So they actually
yeah,
they were raising like tons of like junk bond funds from like Japanese retail investors. They were hiring like J-pop models and professional baseball players. Yeah, they were like doing this on like TV and stuff. It's crazy like how they raise money,
yeah,
capital.
yeah. So I should have been more specific because you're right. They're definitely not a bank, but their balance sheet is definitely interconnected into that web of real banks balance sheets, and that those banks are the ones that are responsible for global liquidity. At the end of the day, it's not the central bank, regardless of what they're doing with QE and QT. So, I mean, we've most likely gone into some highly volatile times. We'll have to see how this plays out. I mean, usually the cycle, that's the only thing I can go on, is I can just sit there and read what the treasury market is telling me and then just try to interpret that for my audience. But it's pretty straightforward. And then I just look at past cycles. And if I say, look, if it's happened this way 90% of the time since 1950, it's most likely, again, no certainties, but the probabilities are high that it plays out this way again. And what you always see, the curve inverted, it stays inverted for a year or 2 years. Now we're long in the tooth, but then you see it uninvert due to a bull steepener, which is the bad kind. And then what happens is it barely inverts or uninverts and it kind of dips back and forth and back and forth, back and forth. And then the stuff hits the fan, the Fed drops rates, and that's what really makes the curve steepen out. And that's usually when the unemployment rate is skyrocketing. And then that's usually when you have the recession or whatever you want to call it. And then what happens is the government or the central planners step in and try to paper over the problem with the next round of CARES Act or stimmy checks or bailouts or whatever it is. So I don't see why this time it's different. I know everyone on FinTwit right now and in the mainstream media is saying that this time it is different, that you should completely ignore the Treasury curve. But to me, that really doesn't make any sense. And the arguments why this time it's different, I don't think are very good.
Well, I think this time is a little different. I agree actually with a lot of what you said, but I think it's a little different that the non-G7 central banks have decided that they're not going to be large net buyers of Treasury. So other entities like the commercial banking system are going to have to pick up the slack for buying US Treasuries. I think like the non-G7 has decided as a policy that they're going to be diverting reserves into gold tonnage. So that it seems like the last 2 years, especially with the Russia sanctions, they've just decided we're dollar cost averaging each month. We're going to buy a small percentage of gold tonnage each month, kind of no matter what. And it seems like it's dollar cost averaging like a retail investor now.
Yeah, but look at what's happening when the stuff's hitting the fan, right? If we go back to, I don't have a chart in front of me, but let's say right after Powell's press conference last Wednesday, we look at what happened Thursday, Friday, Monday, and what caught the bid? It was treasuries. What got sold off? Everything, including gold.
Well,
So
in a margin, and this goes back to the margin call we discussed a couple of minutes ago. I think like stuff's being sold that people don't want to sell. So people are selling Nvidia, people are selling Mag 7, people are selling profitable trades like gold. People who bought gold 9 months ago, I mean, it was at sub 2000. So
yeah,
it's
and I want to be clear, that's not a knock on gold. That's actually the opposite. That's showing you that gold is doing its job. And its job is insurance. And its job is to give you liquidity when there is no bid for anything else. And therefore, it's either go bust or sell something on your balance sheet. And if you can't sell anything on your balance sheet, or you can't sell it at the price needed to not go bust, then gold is your insurance policy. Gold is your get out of jail free card. And therefore, you typically, in one of these liquidity events, you see the price of gold go down dramatically. And again, that's not because gold is bad; it's because it's doing its job. But that's why in this type of environment, I think treasuries are a better bet. And I think that's why you see the bid, and that's why you see the bull steepener and the whole entire curve go down for the most part over the past 2 months, while you see gold struggle. That's not to say that you shouldn't own gold. I absolutely own gold at any price. It's always 10% of my portfolio as insurance. But I think the real upside in gold, and where it's going to be catching a bid from not only the financial players, but retail, is when we come out the other side of whatever recession, hard landing that we have, and the government papers over the problem, and that's usually what creates that tailwind for gold over the longer term.
Yeah, also gold, silver, Bitcoin are anti-central bank digital currency hedges because as you've highlighted in a lot of your research, your interviews, that it seems all these governments and central banks are all progressing central bank digital currencies, which is like taking in a nefarious way, the Bitcoin blockchain code, which is meant to be decentralized. And then they're taking it and making a centralized database so they can track and tax every single economic transaction in the economy.
Yeah, that's the main reason why I did that Argentina trip, is to try to show people, first and foremost, that you need to have purchasing power outside of the system. And obviously, gold and silver is fantastic for that. And so is Bitcoin. I mean, I always say that, where the price of Bitcoin is going, who knows? I think you can make great arguments both ways. My base case would be higher. But for me, the success or failure of Bitcoin has nothing to do with the price. And it has nothing to do with it becoming the global monetary standard or anything like that. It's already been a huge success in my book. And the fact that it allows you to take purchasing power cross borders seamlessly, effortlessly. And even gold and silver don't do that. So, that was one of my main points there, is that yes, when you get to point A or wherever you're going, when you get to point B, I guess, you do need to have a network of people that that can provide you liquidity for that gold, silver, or Bitcoin, because just going there and saying, here I am with my gold, that really doesn't do anything. And you're going to have some problems with that type of strategy. But before you get to that point, you've got to realize that these CBDCs are coming. The governments are only going to get more intrusive. They're only going to become more Orwellian. And therefore, it's great to have stocks or bonds or real estate or whatever it is, but you got to have a portion of your portfolio outside of the system with no counterparty risk and outside of the greedy hands of the central planners and authoritarians.
That's a great point, and people don't realize this, but if they hadn't changed the rules, the FDIC rules on Silicon Valley Bank, I mean, there would have been a lot of rich people in Hollywood and Silicon Valley that would have lost a large chunk of their life savings. So Janet Yellen had to go in there, probably pressure from the other politicians. Those are economic and political elites, and they had to go in there and change the rules for the FDIC limits because there were people who had tens of millions of dollars at Silicon Valley Bank, and then boom, the rules get changed. But otherwise, they would have what got bailed in.
Well, who knows? But I think that's likely in the future if we do have some issues with the banks going bust in the United States. I don't think the depositors are going to take a haircut, but I sure as hell wouldn't want to roll the dice on that. That's for sure. And I think that's another argument for probably not holding treasuries, but holding T-bills, holding like 1 month T-bills. If I had anything over 250, even if I had less than that, anything really over 100, I would take that out of the banking system and I would just put it into T-bills and roll it. Because, if you're keeping that cash in the bank for dry powder, you are taking a certain amount of counterparty risk. Now, it is true that with Wells Fargo or JP Morgan, you're taking a lot less counterparty risk than a regional bank. And it is true they'll be bailed out. And I think the probability of JP Morgan going bust is probably lower than the Federal Reserve themselves. But there's still
Are they even paying depositors? Like if you put a lot of cash at JP Morgan, I know people like view it as safe. Are they even getting like anything close to the short term?
No, not even close. Not even close. So why not just go into a T-bill? If I know you got to hold your nose to do it, but go into a T-bill if it's just the dry powder that you want to have on the sidelines in order to take advantage of maybe some cheaper prices with assets if we do go into a recession. Just for heaven's sakes, I do it with T-bills, just 1 month. Then you don't have to worry about liquidity. You don't have to sell at a haircut. You can just hold it to maturity. You get your money back. You get the interest, and you don't have to deal with that counterparty risk of the banking system.
And the only thing that Warren Buffett, I think, is actually buying in size right now are oil producers like Occidental Petroleum, Chevron, some of those. And then like Stanley Druckenmiller, that was a great trade. He sold out of NVIDIA, 6 or 7 months ago, and he bought gold mining shares towards the bottom there. I don't know what he's doing recently, but he kind of nailed the bottom in the gold miners.
And Buffett's buying bills. They just said, like we were talking about earlier, that he now owns more bills, treasury bills, than the Federal Reserve.
That's shocking. That's crazy. Well, I would like the government to stop buying mortgage-backed securities because they've created so many distortions with that.
Well, I'd like to just get rid of the Federal Reserve. I sit there and talk about how the Fed's balance sheet really doesn't matter that much mechanically. And I think the data supports me on that, but that doesn't necessarily mean that I like the Fed. People
I don't like it.
Those two things. And I think we should end the Fed immediately because even if they really don't impact the market with their balance sheet, they do create quite a few economic distortions psychologically. Not just mechanically, but psychologically. And of course, they impact that front end of the curve, sometimes too low, sometimes too high. But we just need free market interest rates, bottom line.
As bad as the grilling is for like the Fed chairman or Janet Yellen, like in Congress, I mean, I could tell you the majority of both political parties, other than like Thomas Massey and Rand Paul, like they don't want the Fed gone. I mean, they want it changed. They want, you have to subsidize this. You have to bail out that. You have to fund our project for our votes for our district, so my friends can get like this unbidded contract, and I can take care of them, and then get a side deal or a lobbying gig when I leave Congress.
Yeah, it's. There's no political willpower to get rid of the Fed, that's for sure. So that's likely not going to happen. But that's just all the more reason to have some of your purchasing power outside of the system so you have less risk in dealing with the financial system that the Fed manipulates through their psychology, let's say.
Well, George, I want to thank you so much for your time today. Do you have a Rebel Capitalist conference coming up soon?
No, it's in, I don't even know, Jace. I think May of next year or something like that. So people can just go to YouTube and type in Rebel Capitalist. They can check out the live streams I do on that channel, or they can just go to YouTube and type in George Gammon, and then they can see the whiteboards that I do on a lot of these topics that we've been discussing, global macro stuff.